Hey everybody, Boris speaking Forex. Welcome to the weekly technicals for the commodity dollars. For Aussie dollar, dollar CAD, Kiwi dollar, April 29th to May 3rd, 2019. Story in the comp dollar land, of course, was pronounced weakness in the Aussie dollar this week after very, very weak CPI numbers kind of drove the trade all the way down to 70, but we bounced back. And the thing is that we kind of bounced back essentially on the decline in U.S. yields. We had a universal decline in all the comp dollars as the dollar rallied, but at the end of the week, when U.S. yields started to drop off, of course, the comp dollars started to rally back up because their yields are, it's essentially a yield trade on the comp dollars at this point as we go forward. So when you look at the levels, Aussie dollar certainly dropped down to a 71.70 trade. It used to be sort of a 71.72 trade. Now it's a 71.70 trade. And it's very interesting because, of course, a strong dollar move could certainly bust that 70 handle as we go forward into next week, on the assumption that as U.S. yields pick up, even if the Australian yields stay stationary for the near term, there's very much a preponderance of thought that Australian yields could go down. We also have some Chinese data actually front of the week, which will be a very interesting tell, because if the Chinese data does not bounce as the market expects it to, that could put additional pressure on the Australian dollar and even test the 70 before we even have the U.S. data in front of us. The CAD data has been a 34-35 trade. We've kind of peaked above 35 a couple of times, even though oil prices were very, very strong. Then ironically enough, when oil prices got a little bit weaker at the end of the week, we kind of came back down again. Dollar CAD seems to be trading much more in the yield story rather than any kind of internal growth story. But still, the Canadian economy is performing relatively well. The general data here is stronger than I think the market expects. And even though the Bank of Canada is certainly being very cautious and standing on the sidelines, they're not out of contention for being the only other central bank to consider raising rates going forward. So I still think that dollar CAD at this point probably more of a sell than a buy as we go forward, especially because of the technical formation here, where the failure at 35 looks like it could be a move back down towards the 34s. And then Kiwi also had found a relative bid here at the 66 level. Again, it's enjoying essentially the yield trade differential advantage for the time being. And we do have a little bit of Kiwi data this week that could be mildly positive, as we'll take a look. So when we look at the comp dollar data this week, it's not as abundant as the data in the majors. We essentially really only have the Chinese data, which will be important to look at, which is the composite PMI data. If that number comes in strong, that certainly provides a boost to all the comp dollar crosses as we go forward. Then into the middle of the week, we have the Canadian GDP numbers. Here we're bullish Canadian GDP because we had much stronger trade balance data and retail sales. So that again could be another factor that could drive us towards the 134 as we go forward. And then also we have the Kiwi unemployment data coming up on Tuesday. That's going to be a big tell. We are actually bearish this number because PMI shows a little bit of a weaker labor number conditions, and same with manpower service. So here we could see a downdraft if the employment data comes in lower. But if it doesn't, if it's sort of surprised to the upside despite the initial numbers, that should be a really positive move for Kiwi yen as we go forward. And then the rest of the week, there was nothing really on the comp dollar calendar except the services PMI from AIG in Australia, which is generally not a big market moving event. And that's pretty much it. The Canadian labor data comes out next week, so we don't have much to move on. Let's take a look at the charts and just see how everything is setting up here. So looking at the Aussie, certainly a big move to the downside here as we pulled away. Now we're back, sort of away from the moving average. A natural trade to a mean reversion would kind of maybe take us to 71 as a potential resist point here. But as I said, a huge amount of this trade really depends on U.S. yields. If U.S. yields begin to sharpen strongly, it's going to provide perfect catalyst to take out the 70 handle, which is a very big, important psychological handle, and then puts us into a 68.70 trade on the Australian dollar going forward. For now, however, we just simply have to watch the lows, the key lows over here. We sort of did take the 70 handle last week, but it's a typical touch and rebound type of a trade here. The second move here through 69.80s would be a lot more convincing. And if we sort of trade 69.75, 69.70, that would really open up the gateway towards a move to the downside as we go forward. Dollar CAD here, the 3 days of hesitation above the 35 really creates a very, very tempting move to the downside here, and the positive dollar CAD move, the positive GDP perhaps catalyst, could easily take us down to the 34 handle. Despite the fact that oil, by the way, is down, it's still in the 60s, which is a long-term positive development for the Canadian GDP and should be a contributor as we go forward, as the trade balance numbers should certainly contribute because of the oil numbers. So generally, to me, dollar CAD looks kind of the best as a turn trade to the downside here, with 34 perhaps in play as we go forward. And then last but not least, here's the Kiwi trade. Kiwis had a nice big rebound off of the bottom here. We certainly held this this low of this. It's 65.93, basically 66 low. This was the spike low, by the way, of the fat finger low of January 3rd. And since we've bounced back that, it looks relatively decent. Certainly has scope here to move towards the 67s, especially if U.S. yields don't really percolate high and we get a surprise on the employment data that would shock the market. So overall, the calm dollars are showing a little bit of moderation here, but there's certainly danger if the dollar rally resumes for fresh lows. Until we get fresh lows, I really would not be short these trades. I still think they're probably better as turn trades rather than continuation trades here for the time being. And in fact, as we'll take a look at the crosses, I actually think some of them setting up some interesting cross trades to the upside. So that's how the calm dollar is set up. Wish you guys the best luck, the best trading. Boris, over now.